We just went through a month where the market was in complete and utter chaos, and most people are looking for safety. So here's a counterintuitive name, a profitable technology company that pays a dividend, is buying back over 25% of its own stock, has zero sell ratings, and Goldman Sachs specifically called it out as a top small cap pick. Yet the stock has barely moved. That company is OPRA Limited, ticker OPRA. The analyst consensus says it should be nearly double where it's currently trading. And the reason most people haven't heard of it is exactly why this opportunity exists. Opera Limited in 2026 is a global technology platform with multiple distinct revenue streams, over 100 million active users, and a business that generated 615 million in the full year of 2025, growing 28% year over year. They're profitable. They pay a semi-annual dividend yielding around 5.4% annually, and they just authorized one of the most aggressive buybacks you'll see from a company this size. Let me walk you through what they actually have. Opera GX is one of the most popular gaming browsers in the world, built specifically for PC gamers with CPU and RAM limiters so your game doesn't stutter while your browser runs in the background. Integrated Twitch and Discord, a design aesthetic built entirely around gaming culture. Among its target demographic, it has genuine loyalty. Opera News is an AI powered content discovery platform with hundreds of millions of active users. Primarily across Africa and parts of Asia, Opera was one of the earliest companies to crack mobile first content consumption in emerging markets, and they've been compounding that audience for years. Next, they have MiniPay. MiniPay is a lightweight mobile payments app built on blockchain infrastructure, targeting users in Africa who don't have traditional banking access. It's early stage, but the total addressable market is enormous. Non-search query revenue, which includes this kind of adjacent monetization, grew over 200% year over year last quarter. And then there's Opera Neon, launched to broad public access in December of 2025. Neon is described as an agentic AI browser, not a browser with a chatbot bolted on, a browser designed from the ground up for the paradigm where AI doesn't just answer questions, but takes actions on your behalf. Now let's look at the numbers where this company truly shines. In quarter four of 2025, they had 177 million in revenue, up 22% from the same period a year ago. Exceeded their own guidance by more than 12 million. Not a small miss, a meaningful beat. Adjusted EBITDA margin of 24%. This is a company generating a nearly quarter margin on over 177 million in quarterly revenue. For the full year of 2025, they had a 615 million in revenue, up 28% from 2024. Their 2026 guidance has them hitting 720 to 735 million. Even at that 17 to 20% growth rate, while it does look slower than the 28 they just posted, it's still significant growth at a 23% EBITDA margin on a 1.3 billion market cap company. Now here's the buyback. Opera authorized 300 million in share repurchases. The entire market cap is approximately 1.3 billion. They are authorizing the repurchase of roughly 23 to 25% of their own company. Management is looking at $14 a share, saying this is so cheap that buying back our own stock is the best use of $300 million. That is not a subtle sign. Now, there's three reasons this stock is still cheap. The first is the market cap. Opera is a $1.3 billion company. Large institutional funds either can't own it due to mandated restrictions or won't because the position is too small to move the needle for a multi-billion-dollar fund. The natural buyers for large stocks are structurally absent here. The second reason is Chinese ownership. Opera's majority shareholder is Kulon Tech, a Chinese technology company. In the current geopolitical environment and this week's Iran conflict makes geopolitical sensitivity even higher. Anything with Chinese ownership creates perceived risk for Western institutional investors. Opera is listed in the US, headquartered in Norway, builds its browsers in Poland and Sweden, stores data in Europe, but the Kulon connection keeps a certain class of investor away. The third reason, it simply doesn't get talked about. There's no drama, no executive controversy, no viral moment. It just grows, pays dividends, and buys back stock. Now let's look at why analysts believe in it. TipRank shows Opera with a consensus strong buy. 5 analysts, 5 buy ratings, 0 holds, 0 sells, with an average 12-month price target of 26.30. That implies roughly 95% upside from the current price near 1471. Goldman Sachs analyst Eric Sheridan maintains a buy rating, arguing Opera is positively leveraged to long-term secular tailwinds in digital advertising and is idiosyncratically benefiting from geographic and product mix shift dynamics. Lake Street recently raised their target to $26 as well. Now, where's the risk in this company? Well, the 2026 growth guide of 17 to 20% is a deceleration from 28%. That's real. If it falls further below guidance, the stock likely stays flat or falls. Competition in AI enhanced browsing is intensifying. Google is building Gemini deeper into Chrome. Microsoft is putting Copilot into Edge. Opera Neon is promising but early. If the AI browser category is won by platforms with deeper ecosystems and larger user bases, Opera will lose that battle. A profitable, dividend paying tech company growing nearly 20% annually, trading at a price that gives you a 5% dividend yield, implies 95% upside to analyst consensus, buying back over a quarter of their own stock. Goldman Sachs endorses it. 0 analysts have a sell on it. The reason it's cheap is structural. Small cap, foreign ownership, no hype. That's also why it could stay cheap for a while. The question is Opera the most undervalued, profitable tech company most investors have never looked at? Or does structural neglect become a permanent discount? Let me know down below. $792. That's how much revenue this company grew in a single quarter, year over year. Not 7.9, not 79, 792%. And the stock is still sitting near the low end of its 52-week range. 14 out of 14 analysts covering it say it's a strong buy. The average price target implies over 100% upside. That company is Syndax Pharmaceuticals, ticker SNDX. And the reason the setup exists is a regulatory label change that Wall Street analysts almost universally say the market overreacted to. Let's go through this one carefully because there's also a number you're going to see if you Google this stock that requires an important disclaimer. And being honest about it is exactly what separates actual analysts from hype. They have two lead products, one that starts with an R and one that starts with an A. I don't know how to pronounce them, and I'm not going to try and butcher that here. The first, the one that starts with an R, is a menin inhibitor for patients with relapsed or refractory acute leukemia who have specific genetic mutations. Let me break that down. In certain types of leukemia, a protein called menin becomes dysregulated and drives the cancer. This drug blocks menin, disrupting the cancer cell's ability to maintain the molecular signaling that keeps it alive. For patients who have already failed other treatments and are running out of options, this drug is offering something that didn't exist before. The other drug that starts with an A treats chronic graft versus host disease. This is a serious, often debilitating complication that occurs when immune cells from a bone marrow transplant donor attack the recipient's tissue. Treatment options have historically been limited. Both drugs are approved, both are generating real revenue, and both are serving patients who have very few alternatives, which in pharmaceuticals directly translates to pricing power that's difficult to displace. Now that we have a baseline of what this company actually does and who they help, let's talk about that 792% from earlier. Revenue grew from approximately 7.7 million in quarter 4 of 2024 to 68.73 million in quarter 4 of 2025. This stems from the fact that both drugs were newly approved or in early commercial launch during 2024, meaning the prior year comparison is essentially a near zero baseline. When you launch a drug and compare to nothing, the percentage looks absurd. But the absolute number, 68 million in a single quarter, beating analyst expectations by nearly 4 million, is what matters. Prescribers are writing it, patients are taking it, payers are covering it. The hardest parts of a drug launch are already cleared. Now let's talk about why the stock got hit so hard at the end of 2025. In late 2025, the FDA added a boxed warning to the leukemia's drug label. A boxed warning is the FDA's strongest form of safety labeling. A black bordered box at the top of the prescribing information flagging the specific concern relates to differentiation syndrome, a condition where leukemia cells start differentiating rapidly in response to treatment, causing inflammation and, in severe cases, organ complications. This is a known risk with certain leukemia therapies. Oncologists treating these patients are trained to monitor for it. The market sold the stock hard. The fear, physicians would stop prescribing it. What happened instead? Analysts across the board called the reaction overblown. Oncologists who treat relapsed or refractory leukemia already know the risk. A boxed warning formalizes that in writing. It doesn't change the actual risk profile. Prescription data following the warning held up. The stock did not recover. That's the gap. Now let's talk about the target price. Here's where I need to be transparent because you will see a number if you search SNDX analyst targets that looks like a mistake. That's because Mizuho issued a price target of 600 per share in January 2026. One firm, one target. When you average that with everyone else's 30 to 57 range, the math goes to the moon. That Mizuho target is an extreme outlier, and the realistic consensus is approximately 37 to 45 against a stock trading somewhere between 15 and 24. Still over 100% upside at current prices, but nowhere near 800%. I want to be clear about that. 14 of 14 analysts have issued buy ratings. JP Morgan recently raised their target to 45, Citi is at 57, BTIG at 56, Stifel at 45. Let's talk about the future of this company. They are currently trying to address the patient population by expanding it. The hopes is they can get their leukemia drug approved in a frontline acute myeloid leukemia. Relapsed and refractory is a small slice of total AML patients. Frontline is the whole market. That's what the high-end targets are based on. Now, what's the risk? Well, we know that their two drugs are going to continue to grow since they're relatively new. However, a lot of the targets were based off the frontline trials. If those fail, that is the single biggest risk to this company. Competitor menin inhibitors exist. Cura Oncology and others are developing adjacent mechanisms, and one $600 analyst target creates misleading headline numbers that attract the wrong type of investor. When they figure out the consensus is 37, not 600, that selling pressure is real. The bear case. The label change matters more than analysts think. The bull case. Two commercial drugs, 100% upside to realistic consensus, and frontline expansion that could multiply the revenue ceiling extraordinarily. The market is voting for the bear case right now. 14 analysts are voting for the bull one. So the question is a company with two approved drugs, 792% revenue growth, and analyst support really only worth $15 a share? Let me know down below. While the rest of the market has been selling off this week, one small biotech company has been quietly sitting at half the price Wall Street thinks it's worth. And the thing that makes this one interesting isn't future potential, it's that the money is already coming in. I'm talking about BioCryst Pharmaceuticals, or ticker BCRX. The analyst consensus price target right now is right around $20 a share. Stock is trading near 950. That's over 100% implied upside from a company that generated $600 million in revenue last year and is already profitable. Let's break down exactly why that gap exists, what would need to happen to close it, and what could go wrong. BioCryst is a rare disease biotech based in Durham, North Carolina. Their flagship product is called Orladeyo, a oral once daily pill for hereditary angioedema, HAE for short. If you are not familiar with HAE, here's what you need to understand. It's a rare genetic disorder where patients experience sudden, unpredictable swelling attacks. These attacks can attack their face, their throat, and their limbs. These attacks are debilitating and, in severe cases, life-threatening. And until Orladeyo came along, the main options were injectable treatments that patients had to schedule every week or two. Orladeyo changed that. You take a pill every day and the attacks are prevented. For a patient whose life was previously organized around injection schedules, this is a fundamental quality of life shift. And the market has responded. Full year 2025 Orladeyo revenue hit $601.8 million, up 38% year over year. When you exclude the European business they sold in October, growth was actually 43%. Non-GAAP operating profit for the year reached $214 million, a 198% increase from the prior year, nearly triple. This company is not burning cash hoping something works. It already works. On January 23rd of this year, BioCryst completed its acquisition of Astria Therapeutics for 250 million plus milestones. And with that deal came the most important asset in the company's history, Navenbart. Navenbart is a monoclonal antibody for HAE, the same condition Orladeyo treats, but through a completely different mechanism. Where Orladeyo is an oral pill taken daily, Navenbart is an injectable given every 4 to 8 weeks. By having both, BioCryst now owns both lanes of the prophylactic HAE market simultaneously, and the clinical data on Navenbart is exceptional. Phase 3 trial data shows mean attack rate reductions of over 90%, median reductions of 97%. These numbers are among the best ever seen for any HAE treatment in clinical history. That's not marketing, that's what the trial data shows. Management is now guiding for 625 to 645 million in Orladeyo revenue for 2026. Continued growth off an already massive base, and they've outlined a path to 1 billion in peak Orladeyo revenue alone before Navenbart generates a single dollar. Here's the layer that doesn't get enough attention. BioCryst is also developing BCRX 17725 for Netherton syndrome, an extremely rare, severe genetic skin disorder with no current approved treatment. BCX 17725 is a KLK5 inhibitor targeting the specific enzyme that drives the skin damage at the molecular level. It's potentially the first-in-class targeted therapy for this disease. Part 3 of the Phase 1 study involving actual Netherton syndrome patients is underway right now. Data from Part 4 is expected by year-end 2026. If it reads out positively, BioCryst moves into a pivotal study in 2027 and is a second potential blockbuster asset on top of an already proven franchise. So why is the stock still at $9.50 a share? There's a few real reasons. The acquisition was dilutive. BioCryst issued equity to help fund the Astria deal, which pressures the stock short term regardless of how good the deal is. Rising R&D expenses from late-stage Navenbart trials mean 2026 operating costs are going up before the revenue benefit fully materializes. And the HAE market has real competition. Tadaka, CSL, Bering, and others have their own drugs. And then there's the history. BCRX has had periods of excitement before. Stock has run up and come back down. Some investors have been burned waiting. And that history creates reluctance to re-engage. So what are analysts actually saying? Well, there's 12 analysts that cover BioCryst. The consensus tends to be that it is a strong buy right now, with 36 having it as a strong buy, 55% having it as a buy, and 9% saying to hold, while 0 are saying to sell. The average target is approximately 20 to 21 per share. Wedbush recently raised their target to 22 from 21. Evercore ISL has a $17 target with an outperform rating. The high end is $32. At $20 per share, you're still looking at a modest multiple for a profitable rare disease franchise. With a second pipeline drug in late stage development, the math is not unreasonable. If phase 3 disappoints or safety signals emerge in a larger patient population, the Navenbart thesis collapses, and the 250 million Astria acquisition looks like a mistake. Orladeyo also isn't immune to competition. If a competitor shows meaningful better efficacy or tolerability, prescribers start switching, and running a late stage trial Integrating an acquisition, advancing a second pipeline asset, and sustaining commercial momentum simultaneously is a lot happening at once. BioCryst has cleared the bar most biotechs never pass. They have real revenue, real profits, a drug that's growing, and now a late stage injectable with trial data that's among the best ever seen in this disease. The question isn't whether the company survives. It generates over 200 million in operating profit. The question is whether Navenbart turns a good company into a dominant one, and whether the market will price that possibility before it becomes a certainty. So the question is, does a profitable company with a drug growing 38% annually and a second potential blockbuster in late-stage trials really deserve to trade at half of what every analyst says it's worth? Drop your answers below. And as always, remember, this is analysis, not financial advice. Please do your own research.